So in our presentation, we'll go through some of the key identified challenges with implementing a saving scheme for low-income gig workers and go through our proposal to actually solve the issues at hand. So what are the key issues? Well, one of the main issues is that it's not mandatory. So you actually need to tailor the savings account to the low-income gig workers or they will not use it. Secondly, they have high liquidity needs. Their income is unstable and they don't have any built-up safety net, which means if they lose their job, they need some kind of savings account that they can tap into. Second, they typically don't save enough up for retirement. Thus, you need to actually balance with the fact that they can pull the money out of their account while also incentivizing them putting money in their account.
So, in short, our proposal is called the LSR savings scheme, and it consists of 3 savings accounts. We have a short-term savings account, a long-term savings account, and a retirement account. The short-term savings account is designed to be highly liquid and easily accessible funds for the workers in this scheme. Hence, they are allowed to withdraw from this account at any point they want to. Second, we have the long-term savings account, which is a little less flexible than the short-term savings. And this is done so that we are able to invest these funds a bit more classically than the short-term savings account. This, in order to ensure this, we have required a 1-month notice on withdrawals from the long-term savings account. Lastly, we have the retirement account, which is a classic retirement account that does not allow for early withdrawals, and the funds are available upon reaching the retirement age. We have made it so that we prioritize contributions into the short-term savings account, while later we will also then fill the long-term and retirement accounts afterwards.
So one of the issues that we identified is that we noticed that the workers are also enrolled in our LSR savings scheme. However, they can anytime drop out of this savings scheme. We want to minimize the probability of people opting out, as they will not save enough funds for their retirements. So what we have done to ensure that people do not decide to opt out is that firstly, we have decided that the contributions should be made as a percentage of their salary. And this salary should go from 1% to 10% over the course of 10 years. This will help the workers get used to the idea of contributing to their LSR savings scheme by only starting at as low as 1% in the beginning. So slowly we will kind of nudge them to the idea of that they have to contribute to their savings account. Then further, we have decided that that the contribution should firstly be paid into the short-term savings account. This also means that in the first couple of years of workers contributing to their savings scheme, they're able to actually access the money that they have contributed. This also makes it more accessible for the people and more easy for them to digest the idea of having to contribute to their savings scheme. If they are to reach the cap of the short-term savings account, then of course the money will go to the LT and the RT savings account. But in that case, they have a sufficient savings such that they are able to cover smaller financial problems. Another way that we've decided to minimize the possibility of people opting out is to incentivize people from actively contributing to their retirement savings. This we have done by taking the loan and investing such that we get an excess return. This excess return we will pay as dividends to the actively contributing workers, and this is across all different age groups. This also means that even for workers that are young and still have a lot of time to save up their account, they will get something, but also people that may be a bit older and maybe don't see the idea of having to save up for savings for retirement since it's so close in the future. So everyone will get some free money from paying into our savings scheme.
Now on to our asset allocation. We have, by design, kept it rather simple. So we have three different savings accounts with three different needs. So first off, we have our short-term account, which needs to be rather liquid. So this account is fully invested in treasury bills, yielding the risk-free rate. Then we have our long-term account where we can put the money in more illiquid and more risky assets. Here we put it in stocks and government bonds and corporate bonds. And finally, we have our retirement account where we can also include real estate and infrastructure, more liquid assets. Note that we also want to implement a age-specified risk profile, meaning that the closer you come to retirement, the less risky the portfolio for your retirement savings will be. And the weights that you see here on the table are made by looking at comparable pension funds and look what they invest in. And we'll also make use of internal trading. So because of the 1 month notice, we can look, we have people who wants to contribute into the scheme, and we have people who want to pull funds out because they need the funds or they are on their pension. Thus, we can match the income with the outcome as good as possible. And the final note is that the standard deviation number at the bottom is actually the variance.
So one of the other issues that we identified is that there are not sufficient retirement savings upon retirement for our workers. If the workers or Floridians are only to live off their social securities, they would only be able to cover about half of their living expenses. So we need to make sure that the other half of their living expenses is covered somehow with our retirement savings scheme. So what we have done that instead of paying out the entire retirement account upon retirement, we instead decided upon using a payout scheme as a life annuity. However, not a life annuity in a classical way, as we do not have a mortality risk involved. This means that we do not share money between accounts if you die. This is to further make it more simple for the workers, so they do not need to consider what they have to do with their retirement account once they retire. Then they just have a lump sum of money. Now instead, we decided that we want to ensure that they have a life annuity, they have a benefit that they can rely on until they die eventually. This also allows us to continue our investment upon retirement. If we were to pay it all out as a lump sum, we need to sell all of our assets immediately. Now we can sell little by little using our internal trading, and we can also gain some return on the retirement account even when the workers are retired. To further ensure that we have sufficient funds for the retirement account, we have decided that we do not include premature withdrawals. This allows the effect of cumulative return to really take its toll on the retirement account. We can see from the cash flow of the retirement accounts that we will suffice the average Floridian with a cash flow that should be enough to cover the life expenses upon retirement.
And further, we performed a simulation study of this scheme where we created 100 withdrawal scenarios and 100 investment scenarios, and then for each withdrawal scenario, we matched it with all of the investment scenarios, and we have created these simulations. The figures here are for a 35-year-old with a median Floridian salary of $60,000. And we see that for the retirement and the long-term savings account, we have shown the median case and the 25 and 75 quartiles. And we see that the median case yields $300,000 in retirement savings for a 35-year-old Floridian, which also has $20,000 in long-term savings for more than $50,000 in long-term savings for a long period of time. And they also they all empty their long-term savings immediately upon retirement, so these can be used as additional benefits on top of the retirement benefits. And lastly, the short-term savings get emptied around retirement because they will, due to their easily accessible nature. Yeah. Okay.
Amazing. Thank you. So we'll move now on to the question and answer period. So the judges would like to raise your hand and ask any questions. Jennifer?
Thank you for your presentation. So it's interesting that one of the constraints you're trying to solve for is the fact that you don't want people to opt out at the same time trying to give them liquidity. So let's play the scenario where they fully withdraw their short-term account fairly shortly, like within a year. And then you have the alternative for them to also give you 1 month notice to fully withdraw their long-term account. Am I reading that correctly? Is there any constraint on how large the retirement fund has to be when those two things happen?
No, they're separate accounts, so they run separately. But no, there are no constraints on that.
And then taking that a step further, they can also opt out just period after those two scenarios play out. So they can be, I don't want to use the word stuck, but basically they're in a vehicle in which they have money that they can't touch for a very long time.
Yeah.
We thought of the opt-out possibility as emptying all 3 accounts in. But by the nature of our design, we believe that we have incentivized them to stay in this savings scheme and not empty all accounts.
Maybe you can elaborate on that. How did you make sure that that continues?
So we have different nudgings. So first of all, they don't earn that much. So if we take 10% of their salary out of all of a sudden, it will make a huge impact, especially in low-income workers. So we gradually increase that, so they don't feel the burn immediately. Second, we nudge them with the contribution bonus, right? If you actively contribute, you will earn a little extra, and that will skew towards being more helpful for low-income workers, right? Because we don't allocate that out based on portfolio size. We allocate it out to all individuals. So those are some mechanics to actually nudge the people to actively contribute into these accounts. But yeah, there's nothing that stops them just pulling out, right? If they don't want to be a part of the scheme, we are not forcing them.
Rami?
Morning, afternoon, or evening, wherever you are. Thanks for the session. I just want to hear a little bit more about the dividend idea. How does it actually work? I mean, you've got an idea here that, that pool will distribute excess, that $30 billion return, whatever is in excess of their borrowing costs will be dividend back to the people. But could you just unpack that a little bit? I mean, it's different account, different size, different age, just tell us how that would actually work.
So how we have implemented it is we take that sum of money, invest it in a 30-70 split between how the long-term account would be invested, how the and how the retirement account will be invested, and then if it earns an excess return, we take a part of that excess return. So let's say if it earns 5% over a given period, we'll take 20% of that 5% and allocate it out to all of the currently contributing members. That's how we have.
And just to be clear, so equal weight, doesn't matter how much money is in there for each contributing member, they will all have the exact same dividend. Is that right?
Yes.
Everybody gets one share, everybody gets one dividend. Okay, thank you.
Yes, hi. Thanks for the presentation. So as much as this is appealing to keep the money inside the fund, now psychology of the markets is really important. And typically during big crises, everyone kind of wants to get out, and particularly maybe people that know less about financial markets, they might panic more. So I guess, again, more related maybe to the simulations or how you've constructed things to make sure that all the assets don't all correlate together in addition to a lot of outflows happening at the same time.
Can you elaborate that question?
So I guess I'm trying to better understand how you did the simulation, because because when crises happen, things can go fast. Like everyone wants to get out at the same time, and sometimes the assets might not be performing as well either. So I guess understanding how you've looked at this a little bit more closely.
Okay. So let's start from the back. We have, for each asset class, we have taken an index fund, which we believe represents that asset class very well. Then we have taken all of their annual returns over that. There isn't that much data, only like 8 to 20 years, depending on what index fund you use. So we take that, look at the covariances, look at the mean variances, use our asset location, and then we fit some. We have some covariance, have some mean. Then we use that. We look at log returns. So we simulate future log returns, and then we so our investments yield that our simulated log returns. Now for the withdrawal pattern, we have kept it simple as a proof of concept. So there's just every year there's a fixed percentage that you will take some money out, and there's some distribution on how much money you will actually pull out, and they're different for the short-term and the long-term portfolio. So you're correct that in a market where the stock market falls 10-20%, people will be frightened. They will want to pull it out. We have not included that in the simulation, but we have addressed it by including a 1-month notice period in the long-term portfolio and a strict no withdrawal policy in our retirement portfolio. So that's how it's all built up, and I hope that answers the question.
Dylan?
Excellent presentation, well thought out approach, and I like the simplicity of it. But let's start with that. So the tiered system, where you contribute 1%, starting at 1% over a period, and you have that moving up. If you think of the average gig worker earning $27,000, so it would take probably 4 years or so before they can get to that $1,000.
Mm-hmm.
Talk to us from an operational and asset allocation point of view, because that money would be invested in the treasuries at 3.4%, which you're going to be earning less than the 3.5% that you have to pay back on the loan. So in an event where people start withdrawing before they've fully stood up their liquidity account, what kind of mechanism will you have in place to ensure that your pension plan will be viable?
So we chose this $1,000 cap as just a place to start, and could be individual based. So we would be open to lowering it to maybe $500, depending on the emergency liquidity needs of each worker. But further, the dividends will not be in the short term. They will always be in the long term and retirement savings. So even though you only contribute to the short term savings and it's not full yet, any excess returns from the loan will still go to your long-term and retirement savings accounts.
Okay, so you have money being contributed to your long-term and your retirement even before you start contributing to that, I'm assuming. Because think of me as a gig worker. I earn $27,000 a year. I pay 1%. Mm-hmm. That only goes to the liquidity portion of it. So you're saying at that time, the dividends will go to the long-term and the retirement, which I get. So in year 3, I have a liquidity issue. I withdraw. my $500 that I've contributed over the 2 years, do I still get what am I entitled to from there?
You're still entitled to the contribution if you pay your part of the salary. You might take out your short term, but if you're still each month or each quarter or each year when you get your salary, pay that 10% or whatever percent we are up to, pay that in. Well, then you still get the dividend payments.
I see, but remember, you're not going to get to the 10% until you're year.
Yeah,
trying to get. It
Yeah.
will be some time before you get to that 10%.
Right, we started with 3%. So if you're paying 4% of your salary at year 4, right, you are still entitled to the dividend stream.
But also this contribution level, you could, if you want to contribute even more, it's also always a possibility, but we don't want to scare people away immediately, because if people opt out at the beginning of being enrolled, then there's no need for a savings scheme if there are no members at all.
Ken Biz?
Hi. And following, sorry, I just wanted to follow up on that. So is the scaled contribution, is that mandatory? Like first year it's 1%, second year it's 2%? Because some of these gig workers can't afford even to put 2%, 3% into a retirement plan.
Well,
Have you thought about the distribution and the ability to be able to increase their contributions?
Well, you can say if they can't even afford like 1%, right? Then they can't really like afford a retirement scheme. So that's tough. But yeah, we have thought of the that's actually why we wanted to start so low, because we know that low income workers, if they get hit by a 10% take of their salary, they can't afford like their basic needs. But we don't have any proposed solution for if they can't even afford 1% of the salary.
Of course, this level of contributions, we could also change it a bit. If there are some even lower income gig workers, we could say it only goes from 1 to 5%. And if there are some workers who are able to pay even more, you could set it from 2 to 10 or something else. So this is, of course, something that we can change according to the individual needs of the worker.
Campus?
Hi, guys. Thanks for the presentation. I had a question. If you can go to the slide where it has your different portfolios, composition, asset allocation. Yeah, so so these standard deviation numbers are annual? Is that what it is?
But that variation I pointed out, they're actually a variance, not standard deviation. No, they're quite low if they were.
Because I was like, if you have a 6.4 sharp, I mean, I'll buy that all day long.
Sorry. Yeah, we made a silly mistake. It's variance. Yeah.
And so another question for you. I kind of got along the way talking about the withdrawal and the contribution scenarios you mentioned. There was 100 scenarios that you took on one or the other. Can you elaborate a little bit more in detail how you do all of that stuff? Going back to your, if you go back to one of the, I think this one, yeah. So the short term in red, I guess, is a result of just one of the scenarios. Is that's a combination of the 100?
That's the mean over the 10,000 actually. So we have like for each. So we simulate the withdrawal pattern, right? Sometimes they withdraw at year 5 and they have this probability of withdrawing each year. And when they withdraw, there's some distribution of how much they withdraw. Mm-hmm. It's simplistic, but it's a proof of concept, right? So they withdraw this much this year, and then we simulate the returns separately, totally independent of the withdrawal scheme. And then we look at, okay, each year we add, so if they contribute this much into the scheme and it earns this return, but they withdraw this, then we use that and calculate it forward. And then we have 100 different withdrawal paths and 100 return paths, and we cross-tabulate them. So for each withdrawal path, we calculate, and for each withdrawal path and for each return path, we calculate how much the account develops, how it develops.
I see.
So this is just a mean over the 100 times 100 simulations.
Right. So if I look at that red, that the result of that, whatever assumptions you made, that you said proof of concept, is that more or less that short-term account, except a few spots, is more or less always at zero balance, kind of. So in a way, it's just used, you would think, psychologically to get people interested and invested in this scheme as a whole.
Yeah, exactly. Because on average, you pay as much into the short-term account as you pull out of the short-term account. Yeah.
So it's a rolling account, kind of checking. So,
But this is the cash flow. It's how much on average put in. And
yes, I understand. It's a median. Yeah. Thanks, guys.
Mohammed?
Thank you guys for this presentation. You have suggested kind of dynamic asset allocation regarding the age, which is related to the age of the pensioners. Could you please elaborate more on this topic? Who will be in charge of changing the asset allocation once he's near the retirement age?
So we've decided upon using a sort of a life cyclist way of investing. So when you're early in your working life, we will invest more risky, and this also will get you more return on your retirements, meaning that the cumulative returns are able to work more on your retirement account. But also there's also sort of a psychological effect. So when you are approaching retirement, people are more afraid of losing their retirement account. Hence, we also decide upon declining the risk in the retirement account. This will also further stabilize the development of the account. And if you're close to retirement, you want to be sure that the life annuity that you will depend on upon retirement is stable and not a annuity that will fluctuate every single year, because then you're not able to use this as a way of covering your life expenses. If from 1 year it's $10 and then the next year a lot more. So we need to stabilize this cash flow in the end of the working life of the workers.
Amazing. Does anyone else have any other questions? No? All right, let's give a big round of applause to Baesterne.